Mastering Crypto Trading Psychology, How to Stay Calm for Maximum Profits. That's what we want to talk about today. But look, staying calm and navigating big market swings with particularly volatile assets like Bitcoin is not easy. We need to be aware of the different influences and psychological barriers that can impact our trading decisions. I want to emphasize today how to overcome things like the fear of missing out, how to not be overconfident when you trade, how to overcome things like confirmation biases. And stay tuned, because we're going to tell you the one thing you can do to overcome all of these obstacles. This is Crypto Intel. My name is Max. I'm your guide. Let's get started. Okay, so how do you stay calm amid a lot of market swings, especially with assets like Bitcoin that are so volatile? Well, the first step is to be aware of the different influences that can happen as a trader, the different psychological barriers that you can run into. So let's take a look at these. The first I want to take a look at is the fear of missing out, which is basically a fear of missing out on a profitable trade. And this can lead you to make impulsive decisions. When you see Bitcoin, let's just look over here. When you see Bitcoin moving up very quickly like it did here, it's very easy to say, oh, I have to get in. I have to get in right here. And oftentimes what will happen is you'll get in right at the top. And then it'll start going sideways or even going down. So the way to overcome the fear of missing out is to have a trading plan. You need to know what you're going to do. You need to have your trades mapped out ahead of time so that when the price action says that it's time to trade, you're in. And if it's not time to trade, no matter if it's going up or going down, you're not experiencing that FOMO. So that's number one. Number two is overconfidence. Overconfidence really is the belief that you can predict the market and make profitable trades. And usually it's requiring you, that overconfidence feeling is requiring you to take excessive risk or make some reckless decisions. Now, you can look at what happened back in 2022 when the market peaked. And you can see that what happened was that, let's just look at this here. What happened was that we had a top, it started coming down. It wasn't a parabolic top. So people thought, okay, this is probably just a correction. And it was just a correction. We came down, if you look here, we came down about 50, I think it was about 50%. Yeah, about 54%. Then we started going back up again. And as we were going back up, it went higher than the previous high. And so people were overconfident in the fact that it was going to keep on going up, because in every previous cycle, Bitcoin had a blow off top. It went up very quickly, and then it went down very dramatically. It didn't go up, go down, and then go up again. And so this is a good example of being a little bit overconfident. And it's a good example of what's called confirmation bias. And this is the tendency to seek out or interpret information in a way that confirms your existing beliefs. It's really looking at patterns in the past and assuming that it's always going to be that way. So what are the patterns in the past here? Well, if we keep on looking back and we go back to the last cycle, you can see that Bitcoin had a sharp rise and then fell off. If you keep on going back, and it's hard to see, but you would see in the cycle before, it did the same thing. It had this sharp peak and came back. Whereas in this past cycle in 2022, it had two peaks. And so the confirmation bias is to assume that once it has one peak, that's going to be it. Or if it has a double top here, that's going to keep on going on. So these are a couple of different biases that can affect our trading. Okay, so we looked at a couple of trading biases, trading pitfalls, if you will. FOMO, we talked about overconfidence, we talked about confirmation. Let's talk about a few more, because the next one on the list would be what's called anchoring. And anchoring bias is really the tendency to rely too heavily on a first bit of information that you receive, or the last bit of information that you receive, and make your decisions based on that. And remember, all of these pitfalls, all of these biases really are solved by having a very solid trading plan where you know your strategy or your strategies, you know when you're going to get out, you know when you're going to have a stop loss, and you follow your plan without emotion. But, anchoring happens because we get attached to something. We get attached to a particular stock or a particular asset, and we allow ourselves to just look at the most recent past or the most recent information, and we start to make decisions based on that instead of on our plan. Now, another pitfall is what's called regret aversion. Regret aversion, and this really is the tendency of being afraid of making a mistake. And if we do something, we regret it later. And it can lead us to be indecisive. It can lead us to avoid taking the necessary risks that you have to take when you are trading. So how do you solve this? Well, you solve the regret by asking a very simple question. If this probability happens, or if that probability happens, and I haven't done X or Y, will I regret it? So, for instance, let's take a look at the price action right now. Let me just make this a little bit bigger. And you can see that basically, Bitcoin is moving in a range. Okay, so we can put a line here. I'm just going to do this quickly. We can put a line up here. So the range is between 25 and 31. So here's the question. Here's how to avoid having regret in our trades. We are right here today as of October 12th, 2023. Now, you can say, okay, suppose Bitcoin breaks this. What will I do? Suppose Bitcoin breaks this resistance up here. What will I do? Do I have a trading capital so that if Bitcoin breaks down, whatever trades I have on now, I can move out of them, or I can have enough capital to buy in on a dip buy? If Bitcoin breaks through here, do I have capital to be able to buy some Bitcoin on its way up in the amounts? So you need to look at the price action every day, and you need to ask yourself, if it moves in either direction, what will I want to do? And if I don't have the funds available, or if I don't have the trade setup made in my mind, will I regret it? Regret aversion is preventable if we just, again, have a trading plan and look at where we want to trade and what we want to do. Now let's take a look at a couple other fallacies or problems that traders run into when they're looking at price action. So the next one is what's called sunk cost fallacy. And basically what that means is that say you bought an altcoin or an asset, and you bought it when you thought the price was going to keep on going up, but it didn't. It started falling down. You thought it was going to rebound, and it didn't, and you just held on. And you held on too long. And so what happens is you hold on to a losing trade. You already lost money, and you just start hoping that it's going to go back up. Now, in crypto, sometimes it will go back up. So you can have bought some altcoins over here in the peak in 2022. They can be down 80-90%, and they could come back up. But again, the way to overcome being stuck in an altcoin or being stuck in an asset is to have a very clear exit strategy when you make a trade, even if it's a long-term trade, even with something like Bitcoin. If you're looking at Bitcoin to go up in this next bull run up over $100,000, you don't just buy it and then just wait until it gets to the price that you think it's going to get to. You don't know. You don't know if it's going to go higher than 70. You don't know if it's going to go up to 200. You really just don't know. We can look at past patterns. We can look at past cycles. But the fact remains that we need to be taking profits as an asset is rising in price, especially if it starts to rise in a parabolic way, in a very fast and quick way. So, sunk cost can be overcome by taking profits. That's why we need to take profits. Now, one other one that's important to look at in terms of trading is what's called the gambler's fallacy. And basically what the gambler's fallacy is a belief that past events can predict the future. A trader might believe that a stock is more likely to go up because it was going down in the past few days, or an asset pattern that we've seen in the past at a certain time frame in this might repeat again. And it's possible that it will, but to believe that that is the only outcome is really setting yourself up to make a mistake. You need to look at all the possibilities and all the probabilities. And again, we can go back to the parabolic top right here in the 2017 cycle, where Bitcoin had a very fast rise and then a relatively fast. So to assume that Bitcoin's price was going to be parabolic in this past cycle because it was in the previous cycle is a fallacy. That's part of the gambler's fallacy, if you believe that that was the only possibility. And of course, it's never the only possibility. So again, having a trading plan where we look at all of the possibilities and then from that determine what the probabilities are and make our strategies align with those. That is how we overcome these types of pitfalls. Okay, so finally, let's talk about one more fallacy that we need to be aware of, and that is called the recency bias. And basically, what that means is that there's a tendency for us to give a little more weight in our trading decisions to recent events rather than to events in the past, and to actually allow recent events to kind of blind us in a way to where the price action might go. So for instance, especially in this time when the federal government is fighting inflation, raising interest rates, maybe putting a pause on the raise of interest rates, when we have an FOMC meeting, for example, there's going to be a tendency to look at what that decision is and maybe be overconfident in how it's going to affect the market. The best way to defend against a recency bias is really to not make impulsive trading decisions when there is a big news event or a big economic event happening, like the inflation data or the FOMC meeting, for example. So these are some of the fallacies, some of the pitfalls that we need to be aware of as we are going about our trading. And again, I'll say it one final time. The way to overcome all of these pitfalls is to have a strong trading plan, a very clear idea of the strategies that we're going to use to trade, and have that plugged into our trading plan, have very clear exits and enters established. So that's all for today. Hey, if you like the content, please give us a like, subscribe, and I'll see you in the next time.